What if I told you one of these FLEXI CAP giants has delivered returns north of 77%, but not all that glitters is gold? Welcome to the ultimate face-off between India's top 6 FLEXI CAP funds, where we decode the DNA of the biggest names in the game to find out which truly deserves a spot in your portfolio. From Quant and ppfas to HDFC and ICICI, we're breaking down the stars and surprises across the board. So stick around to discover which fund fits your investing style best. So what exactly is a FLEXI CAP? Think of it as a fund with complete freedom. The management team moves between large, mid, and small cap companies depending on where they expect the biggest gains. The mandate requires a minimum of 65% in equity at all times, making it a core holding for long-term wealth. If you're starting in SIP, a horizon of over 5 years is the golden rule here. Let's meet the contenders. We have the veteran quantflexicap, established in 2013, and the famous compounder Parikh or ppfas. Then there's the legacy heritage of HDFC, known as the behemoth, and newer heavyweights like ICICI Prudential and Nippon India, which joined the ring in 2021. Each one brings a radically different strategy to the table. Size matters in mutual funds, and we call this AUM, or Assets Under Management. ppfas sits at the top with a massive 1.34 lakh crore, followed by HDFC at over 1 lakh crore. While these giants offer incredible stability, smaller funds like Edelweiss with just 3,203 crore are often more nimble, allowing them to make rapid pivots into small cap stocks that the big guys might find hard to buy. Let's look at asset allocation. Most funds like Nippon and ICICI stay almost fully invested in equity at over 97%. But look at the outliers. ppfas acts as a diversifier, keeping significant portions in debt and cash. Then there's Quant, the outlier, which actually uses an aggressive leverage model with negative 13% cash to amplify its market positions. How smooth is your ride? We use standard deviation to measure volatility. ppfas is the smooth cruiser with a low score of 8.46, meaning it protects your sleep. On the other end, Quant is the roller coaster with a score of 16.36. If the category average is 12.72, you need an iron stomach to handle the swings in the Quant fund. High returns mean nothing if the risk taken was reckless. We look at risk-adjusted returns to see who gives the best bang for your buck. ppfas and HDFC lead with elite efficiency scores of 1.58 and 1.56, well above the category average of 0.92. Interestingly, despite its high returns, Quant shows the lowest efficiency for the level of risk it takes. Where are they actually betting? The strategies are worlds apart. HDFC is all in on financials at 39%, while ICICI puts a massive 34% of its weight into consumer discretionary. Quant leans into energy and utilities, while ppfas includes technology in its core. Buying all these funds doesn't give you overlap, it gives you different visions of India's economic future. Every fund has a conviction stock. For ICICI, it's TVS Motor at nearly 10%. For ppfas, it's international flavor with Alphabet or Google and Power Grid. Quant bets big on Adani Power, while HDFC sticks to Axis Bank. The consensus, where they all agree, is high-quality names like HDFC Bank, ICICI Bank, and Larsen & Toubro. Here is your master cheat sheet. If you want the agile players, look at Nippon or Edelweiss. If you want the lowest risk, ppfas is your winner. If you want momentum and leverage, Quant is the X factor. Every fund has a specific DNA, from ICICI's consumption bet to HDFC's massive financial sector focus. So which fund fits your DNA? For a sleep well compounder, choose ppfas or HDFC for their elite efficiency. If you're an alpha thrill seeker, Quant is your aggressive pick. Consumption believers should look at ICICI Pru, while those wanting nimble diversifiers should check out Edelweiss or Nippon. Which one are you picking? Let us know in the comments. If you found this FLEXI CAP mutual fund deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.